So Chris, let me start with you as the bond guy here. We saw the yields really shoot up. They've settled back down now some. They're staying pretty under 3 so far as we can tell. Is this a time to be investing in bonds?
David, I love that clip. Thank you for showing that because I remember that show. I made my wife delay our dinner out on Friday night just so we could watch Lou. My favorite coverage all the time. You know, I'll quote Howard Marks here. If you buy bonds and can hold them to maturity, that's a good, safe investment, and you can get high yield bonds north of 7%, which is a good return. The problem for most of us is we have to mark those to market. And the Fed is going to raise rates consistently because now, unlike 1984, we do have inflation and the Fed is trying to fight it. So bonds, I think at this point, I would be underweight fixed income. And I would not try to hold a bond because I think yields are going to go higher and higher, which is going to drop those prices lower and lower. This is a time where you need to find good long-term but safe and boring investments. So when I think of Sarah and always buying kind of stocks, what kind of boring stocks are out there?
Oh, I love being associated with boring.
Well, but no, he's asking you what kind of boring stocks are there out there, Sarah? Can you find some for us?
Oh, of course. I have a whole portfolio of them. But what isn't boring is what's done so well this year, energy. I would have had old fruit thrown at me 2 years ago if we talked about oil and gas stocks. And then you have all the other defensives, utilities. The metals have done well, the consumer staples. And what has been a disaster this year to date has been the prior darling, the information technology sector. It's particularly bad outside the US and terrible in the US, second only to consumer discretionary. And they both had their multiples massively contracted. But in that rubble of IT, the information technology sector, there's some fantastically defensive companies. We call them value tech. And again, I get a big yawn for that. But companies like Fiserv, which is one of we think the best financial technology companies, they provide merchant acquiring, bank processing software. They're critical for banks and credit unions to run their transactions. And that means the business is really sticky and the multiples on the stock is quite low. The management's excellent. They made a big acquisition. They're paying off the debt associated with that. It just goes under the radar. But for every one of those transactions, there's a fee. And so it's one of these wonderful, dull businesses, and it generates so much cash. And that's exactly what we're looking for now for clients, are businesses that can just ride through whatever the economic environment is ahead and deliver. And that creates less volatility and some downside protection.
So Chris, does it sound good to you, boring stocks?
Well, what sounds good to me is steady cash flow, you know, and the kind of stock that Sarah's describing, I would describe also as infrastructure. We do those kinds of investments. So outside of the equity market, when you own a pipeline, or better yet, you own an electricity line, you own a toll road, that steady, consistent cash flow really pays off. And real estate in this kind of a market, I wouldn't be a big buyer of real estate, but if you've got it and you can hold it, then you've got some steady cash flow. So those are the kind of things that help you through this type of a difficult market. All of those levels of uncertainties, not just the Ukraine war, the struggles with China. And I think it's a real challenge when you look around the world to find those kinds of investments. Sarah, you invest in the emerging markets. Are there those kind of boring yield opportunities in EM countries?
Not many, because people tend not to go to high-risk geographies to get boring. Usually they want growth, and they're willing to take some risk to get it. But you mentioned China, Chris, and China's fascinating because China, in a way, is ahead of the rest of the world in terms of earnings downgrades. We've had COVID arrive later, and it created major lockdowns in Shanghai and Beijing, and you have like 50 million people were stuck in their homes, more than that. So all of that has created a real impediment to economic growth, and hence the earnings downgrades. And the stock market was absolutely horrible. So the Chinese companies trading in Hong Kong, the ones trading in the US in ADRs, and the ones trading in A shares on the Chinese mainland exchanges, all of them terrible. And this is a rare opportunity, in China being the largest component of any emerging market index, that just means that the indices have fallen, but there is the potential for significant recovery because the only central bank globally is engaged, major central bank engaged in stimulus now, not tightening, but stimulus is China's.
So one thing that certainly was not boring this week was ESG investing. We had some very senior executives lose their job over it. A lot of accusations of greenwashing. Where is ESG investing at this point? Chris, let's start with you. What do you think about ESG? Is it here to stay? Is it really having a tough time of it?
Oh, there's no question it's here to stay. But David, let's get away from the initials. And if I mention to you long-term business risk, everybody and every CEO would absolutely agree. Yes, there's greenwashing, but the question is, and you led in on the show with it. On one hand, you have us sending weapons to Ukraine, but then the horrible school shootings. And as a fund that represents teachers, we're offended by the lack of federal follow through on gun control, or at least a better sustainable industry. Their ESG is absolutely a reality, whether it's environmental, social, or governance. And I've been saying for a long time, David, that climate change is real, material, and it's going to massively impact our lives in the next 10 years, not in the next 20, it will in the next 20 actually, but definitely in the next 10. And people have to realize that. So, I think people like Sarah really have to think about what I consider sustainable questions for companies about how they operate today, and are they going to be able to operate into the future?
Chris, it's so much more than that. We've had to prove to our clients that these criteria that, again, as you rightly know, we've been using this, and the active management is all about finding better managed businesses that treat the environment appropriately, that don't abuse their employees, that are governed so that they reward shareholders above all. But we can't have companies in the portfolio that don't perform. So using these ESG criteria to isolate those stocks that are going to outperform their indices, that is the holy grail. That's what everyone's working on now. And we've hired a number of people to do that. We're focused on it, all of our research. But what's different now is it's one thing to investigate and use data and say, all right, these companies are doing a better job. It's another to push them, this active engagement. That's what's different now, is leaning on the management teams and the boards of directors to clean up their act, to become more, for example, environmentally friendly, amongst a whole variety of demands that we're making, not because of our values, even though they may be our values, it's because it leads to performance improvement.
Chris, David, I think you hit it on the head when you said greenwashing. CEO words are cheap. Right. They really have to show up by their actions. And I agree with Sarah that engagement, holding CEOs accountable, making it part of their compensation, thinking long-term is absolutely critical.